Hi, and welcome to the June webinar for the money series that I'm running in this year. And I can't believe we're already in June. This is really wow. The year has flown. June is birthday month in my world. So it's I'm just gonna if you can just turn your video off again. So
Sure.
just because it's easier for
Look, yeah, yeah,
to see
sure.
the screen. Sorry.
Yep, yep, yep.
And just, yeah, I'll just mute you as well, just until we get to the question and answer section. And yeah, so it's my daughter's birthday on the weekends, and it's my husband's birthday on this week, and then it's my dad's birthday and a week later. And so it's like it's birthday. And I'm like, oh my gosh, we're already here. So today we're going to be talking about how to create wealth. A very interesting concept because some people are like, oh, I can't even get my day-to-day expenses under control. How do I even think about wealth? Well, it's really important to be thinking about it regardless, which is why I talk about it. And you'll see why. I won't reveal too much until I get there. So a little bit about me, if you don't know me, my name is Alpha, and I work with predominantly women in business to help them understand and manage their money mindset and the stories and the patterns that go with that, and then also to actually then work on the systemizing of their money, so the business finances. Even if you've got an accounting system and a bookkeeper, you still need to actually have an overarching strategic system for your money. And then you can use the same strategy or the same approach in your personal life so that you're not stripping too much money out of your business and you're also structuring your personal finances in a way that's aligned. So it's very much this integration piece from the mind to the business to the personal. So that's what I do. And the reason I do it is because there's so many amazing businesses out there that do wonderful things, and you want to be able to scale and grow and amplify your impact. You need to get your money sorted. It's just the reality. So yes, and a little bit about my background. I'm originally a tax accountant, corporate tax accountant. That's where I started my life. So that's me there as a very young, naive little grad working at KPMG. And I really enjoyed the people I worked with. Oh, we've got somebody joining us. And hi, Cecilia. Nice to have you here. I've just started to actually go through a little bit of my story. This is all recorded though, so if you did miss anything, you can always go back and watch. But welcome, and I'll keep on moving. Um, and so, yeah, so I started out in the space where I really enjoyed the work that I was doing, working, I was helping companies do their tax returns. I was working with individuals as well. But the work itself, I just found it was surface level. And I really liked to actually help solve the problems that went behind it, when people had no idea what they were doing. So I really liked that part of it. And so I stayed in tax for a little while, and then I made the leap and moved more into management consulting. And I was still working with numbers and finances and spreadsheets and helping. And I found what I was doing constantly was helping organize and systemize and yeah, coordinate people's numbers, money, finances. When you're with a company, then it's more the business side, and then and project finances as well. But what I really, really enjoyed doing was individual work. And that's when my own journey had also started. Even though I'd studied accounting and I worked in the accounting and finance industries, I realized I actually didn't really know anything about personal finance. And I got a financial planner because I thought that's what you did. Then after about 6 months, I started to really question what he was doing. He had my mum and I both in the same things, and we're different generations, different stages of life. And it just rang some alarm bells for me. So I actually went and studied the Diploma of Financial Planning, as you do, because I was really fascinated by it. And I was astounded by what we don't get taught. And that's when I started like shouting from the rooftops. I was like, wait, there's things that we need to know that we don't know. But what I then also realized was that a lot of what was holding us back was up here. There was a certain blockage that we had, and a lot of women in particular have how they can manage money, and a lot of it was and related to. There's a lot of generational concepts behind all of that. There's a lot of gender biases, and we're also told a lot of nonsense, like outright nonsense, not just about our ability to manage money, but so much of who we are and the identity that we have is built around someone else's story. And I'm not going to get too much down that path today. I get very passionate about it because we're here to talk about wealth. But when I started down that path, I was on my own like personal development journey. And one of the highlights was just why I've got that photo there from Uluru. It was a couple of years ago, taking my then 6-year-old daughter to see it. And we went on a helicopter tour. We did all the things. And it was so nice to be able to have the opportunity to do that, because I had always wanted to go to Uluru, but it had always been in the it's too expensive basket. So that was a real highlight. So what are we going to talk about today? I'm going to talk about what wealth actually means. So when we talk about the word wealth, generally we go straight to money, but it does actually have a wider definition than that. So I just wanted to explore that a bit before we get into the mechanics of it. And then I'll actually talk about what the elements of wealth are and why they're important, and the timing of it as well. A lot of things when it comes to money is timing. And then once you know these things, what do you do next? So that's what we'll talk about today. And there'll be time for question and answers. But if there's a burning question you have as I'm going through, please just pop it in the chat. I do have the chat open. I did have it open. So, or you can just unmute and ask me. That's another way of doing it as well. So what is wealth? Wealth, when I actually looked in the dictionary, because I was curious as well, it means an abundance of, or plentiful supply of. It's probably not where our minds would originally go. So when you think, somebody is wealthy, they're, healthy, wealthy, and wise is kind of where we got the trifecta for a long time. And the wealth part was always associated with money, the amount of money we have, what we have in our bank account, the amount of assets we've got, that sort of thing. But like I said, it relates to so much more than just money. We can have an amazing amount of wisdom and wealth, like wealthy in wisdom, wealthy in our relationships, wealthy with love. Like there's so many different ways to look at it that our modern society just hasn't explored the word in that way. So I'd like us to try and expand the definition and how we actually see it. So I do a lot of work with values, beliefs, and then habits as well. And a lot of this starts inside and it works its way out. So the values are the things that we value most. And it's not just things and people, it's our core values, what actually drives us. So it's very intrinsic. Then the beliefs that we have, they're often other people's, to be honest. So if we started to really delve into who we believe we are, there's so many layers to that, which I won't get into today. And then the physical manifestation of that is often our habits, the things that we do repetitively. And they're fundamentals to the concept of wealth. And so then we start to learn the knowledge side of it, which is, how to save, how to spend, how to invest, like all of these elements of it as well. And then we'll talk about net worth and retirement. So I'm going to talk about both of those today as well, because they're terms, but they're important terms to know. Before we do that, however, I'm going to talk about the concept of a lifestyle vision. And when it comes to wealth, it's really important to have clarity. And when I say clarity in what you actually want and what you're heading towards. And this is also why it's important to understand your net worth and then also what your retirement number is, because what are we heading towards? I've worked with so many clients who've gotten themselves into so much debt because they had this idea of, well, I buy the big house, I buy the big car, I do everything, in big, or, go big or go home. There's that saying, which drives me nuts sometimes. But it's about being clear on what kind of lifestyle do you actually want. I follow this lady on Instagram, and it's beautiful. She actually runs a very eco-sustainable business, and she herself lives in a tiny home on she's bought a portion of land in the bush, and has like a little plunge pool. It's her and her dog, and it's beautiful. She's got everything she could possibly need, and then the want side of it as well. She's got a patio, and it's very simple. And for her, that is what she wants. Whether or not you want the big house, like I said, one of my clients had this huge house and was really unhappy because they're like, well, they take a lot to clean, so they've got a cleaner in to clean the house, and like, I have nowhere to put a veggie garden. There was literally no plot of grass anywhere. So I was like, well, you could get pots and do sort of like a climbing garden, but it was more the ability to have grass that her daughter could play on, or that she could walk in, and that the house didn't have that. But because there was a lack of clarity when they were looking for a house, all that they wanted was big. And that was the only criteria. But the big wasn't what they were wanting or what she was wanting. So it's understanding when you want the things that you want to, because there's stages of life. We have a family, so our houses get bigger, and then our children grow up and move out, and then maybe our houses get smaller. And it's just important to understand when we want the things that we want. And then how do we see the world and touch it and hear it? And I won't go into too much detail of this, but it's really important to make sure that there is a certain level of clarity, and it's at a sensory level. And I do have a meditation that helps with this if you're interested, but and then the values are aligned. And that part is really important to then the next steps. So the retirement number, like I was talking about, how much do you actually need? Like, what lifestyle do you even want in retirement? Do you want to travel the world? Or have you done a lot of travel and you want to be able to kind of hibernate? Do you want to get a caravan and travel around Australia? Or do you want to be able to go visit your kids around the world? And what do you want to do? And then how much is that going to require? How much will you need in order to fund that sort of a life? So it's really, really important to have that clarity again and being intentional with it too. And then the other things to consider too is your age at the moment, the age that you want to retire at. I love what I do, so I'm like, well, the concept of retirement is probably a little bit fluid. Whereas my husband, he's just like getting to the finish line. He cannot wait to stop working because he really doesn't like what he does. So that part will come into the decisions as well. And then how much you think you'll need. There are some calculators. I mean, you can Google this and go, how much do singles or couples need for a basic retirement, moderate, and you can get some indications of some of that. And it's generally around between the $25,000 and $55,000 per annum mark, depending if you're single or in a couple and what you want to do. And then how much do you have in super at the moment? And then what can you contribute each year up to the retirement age to try and really boost that? And then what sort of return? Yeah, there's lots of things that go with super as well. So it's understanding some of that. There is actually a calculator, which if you'd like the link, let me know and I can send it. But it basically helps answer a whole bunch of these questions, and it kind of pops out a number at the end. And then there's also the MoneySmart website, moneysmart.gov.au, where you can go in and you can do a little bit of a projection as to what you've got now, what goes in each year, what you anticipate you'll go in, and for how long, and then where you'll end up. So all of those become really good indications to give you information to work with, so that you know where you are now and then where you need to be so that you can start to make some plans to get there. Net worth is another concept which comes up quite a bit. And I get a lot of clients who are a little bit freaked out by it because they're like, oh, I don't want to put this on paper. I want to see how bad it is. The thing is, more often than not, it's actually better than people realize. And even if it isn't, it's better to know than to not know. And it's because once you know, you can do something about it. And knowledge is power, as the saying goes. And it really is true. And the one thing I've noticed when it comes to money is the more you hide from it, the harder it gets, but also the harder it is perceived to be as well. Because you've got this thing growing and growing in your mind that just feels a lot bigger than perhaps it even is. So the net worth concept is literally just listing all the things that you own on one side and then all the things that you owe on the other. And then you total each of those columns up, and then you take what you owe away from what you own, and it'll either be a positive or a negative number. And this often changes depending on your stage of life as well. Quite often in your 30s, you're still building. You might have just bought a house, so you've got a lot of debt. So there's a lot of what you owe. And the equity in the home hasn't necessarily risen yet because you haven't paid it down, and property prices and all of that. So you might actually find it's negative at some point. But it's important to recognize that it's point in time. So over time, it will change. And there are things that will improve it over time, like your superannuation balance, because that is an asset as well. And there's other things you can do, which we'll go through today to help you build up the own side of things. One of the things that I find is probably the most important message out of all of this is whether or not to do things in parallel, one thing after another, or doing things all at once. So I've called it wealth in motion because if you look at the left-hand side, it's very much, it's quite, I couldn't do it too linear because I would have run out of space. I could have even done steps actually, but this just seemed a bit more appropriate. So when you think about our lives, we have our childhood, we get educated, we get a job, we start experiment a bit. There's a bit of trial and error. We make some mistakes. We spend a bit too much. We get into some debt. We, play around with money. But ultimately, in the back of our mind, we know we need to save for a house. That's kind of the thing that we're all told to do. So we play around a bit when we get some money as a young grown up. Then we start to go, okay, I need to knuckle down and save. Buy a home. Right. Biggest investment you'll probably ever make, buying the home. And then it all becomes about paying off debt, because now you've got a loan for a car, a loan for a home. There's other credit card debt. There's probably other debts around there as well. So just life just becomes about paying off debt. Sounds exciting. Then, you get to the point where, you're close to paying off your home, or maybe you get there pre-retirement, which would be pretty exciting. And then you're like, okay, I've paid off my home. Now I can start to invest. And you're like, oh, wow, I've got like 5 years, maybe 10 years before I want to retire, if not already. And now I'm retired. The money I have, I need to live on. I don't have any money to invest. So it starts to become this thing where we've done everything in a step-by-step manner, and we haven't actually built any wealth per se. And maybe along the way there, an investment property, maybe some shares here and there, but unless it's very conscious, it's usually a bit accidental. And I watched this happen with my parents as well, and my dad in particular. He just like randomly would buy a property here or a property there, and then he'd lose money on this one and he wouldn't make any on this one. And it was so random that in the end, he's lucky to get what he had. And it was purely because he bought some property in the really early days. Oh, I see there's a chat. Okay, no worries, silly. Thank you. Yes, the replay will be up shortly. Okay. So in order to build wealth, we actually need to do things all at the same time. So we can't so we look at the savings. So we've got our piggy bank, we need to save, and then we're working. So we're earning money. We're paying off debts, but we're also investing, and we're carving up our money, and we're saving and spending in a very systemized way. So this is where we're aiming to be, is what I call wealth in motion, which is everything is in it. It just all goes around and around, and we can automate a lot of this as well. So that's ultimately the wealth circle and where we want to get to. So what are the elements of that? Well, when it comes to the spending side of it, we need to look at the differences between expenses and debt. And a lot of us are just so used to getting bills and paying them, or they're automatically deducted from our bank account. So it all just becomes this mishmash of money that's just constantly flying out everywhere. But it's important to recognize what are expenses, what are debt. And within the expenses space, debt to a certain extent as well, but within the expenses space, what do we need versus what do we actually want? Now, cognitively, I know that you know this, because when you read it, you're like, oh, yeah, that makes sense. But it comes down to what we're actually prepared. And once we have clarity of the kind of life that we want, it makes it a lot easier to differentiate between the needs and wants. And then to be able to go, okay, well, I absolutely need to have a roof over my head. So yes, I need to pay rent. So we're just talking expenses here. The debt becomes mortgage. So we'll get to that in a moment. I need to pay for rent. I need to eat. So I have to pay for groceries. I need basic toiletries and medicines, because without that, I won't be healthy enough to work, in which case, the whole thing falls away anyway. I need some basic, and I've emphasized basic, clothes and shoes. And I'm the first one to admit that I have way more than basic. So that's an area I still need to work on. And then transport. So how do we get from place to place? It is really a need. We can't walk everywhere anymore. We can't cycle everywhere anymore. Cities have expanded the ability of our physical bodies to get around. So we do actually need to pay for transport, whether it's public transport or a car. I had a colleague once who tried to get around purely by public transport, and he actually lived near a train station. And even then, he's like, it's just really hard. Ended up having to pay for, they didn't have Ubers back then, but having to pay for taxis everywhere. And he's like, I'm probably just not paying the same amount than if I had a car. So you see, what depends on your lifestyle. And if you've got children, it gets way too hard. So then we look at the stuff that we want. Mobile phone. Yeah, that one was, because these days we all need to be connected. So I actually almost put the mobile phone into the need category. So that one, yeah, that one's that one could be in the needs. But a tablet, we don't all really need a tablet, because all our phones these days are like little mini tablets anyway. And some of the phones are becoming large enough to be mini tablets. Any extra clothes and shoes, makeup to a certain extent, alcohol and cigarettes absolutely is a want. And then there's so many other things that can go in that space as well. The eating out, and you still have to enjoy life, but it's just giving you an indication of how to differentiate between the two so that you can very consciously make decisions. Then when it comes to the debt side of things, there's a concept of good debt and bad debt. And this is where my accountant hat comes on. Good debt is something that generates income. So even our homes, unless we're renting out rooms or doing something, our homes actually under that definition would be classed as a bad debt because they don't accept that their value of the asset goes up, but they don't actually generate any income. But that one we're going to park off to the side. But good debt is something that generates an income or is for an appreciating asset. A car is not. So a car is one of those classic things that I see people go into a lot of debt for. And unless you're buying some really amazing car that's got some sort of special thing that the value goes up, which is really unusual, it's going to be in the bad debt category. And pretty much anything else that you can buy that's not an asset that will appreciate is also going to be considered a bad debt because it won't be making any money. So, and again, not necessarily a bad thing. You just need to be aware of it and conscious that that's the decision that you're making, or the choice that you're making. So consolidating to eliminate is something that I found myself in this position because, you know, in my 20s, I suddenly had money. And wow, when you have money, you want to enjoy life a bit more because it's human nature. And then you spend a bit too much money. And I found myself in a position where I had some credit card debt that I was not able to pay off at the end of the month. And so I thought, oh my gosh, this is ridiculous. How did I get myself into this? I'd always been really good at saving, quite a low risk profile. So I didn't lose money on like investments or anything, but it was just buying stuff. Like it really wasn't, anything particularly necessary, but it happens. So one of the first things I would suggest is trying to consolidate. If you have a home loan and you can get rid of personal debt and credit card debt, all of that, and consolidate in your home loan, try that. It does take refinancing to do that, and not all banks will do it. And it depends on your credit history and also on your equity in your home. But try that. But then close, tear up, do whatever you need to do to not spend on those things again. The whole point of doing this isn't you do it every 6 months or a year. This is you get out of jail free card kind of thing. That's exaggerating, but you do it and then eliminate the temptation to get into that position again. You can go, what I ended up doing was doing one of those balance transfer credit cards. So I put all of my debt onto a new credit card, which was zero balance transfer or 0% interest rate for 6 months. And I hammered that debt. I made sure I paid it off in those 6 months so that I got rid of it. And then I tore up cut up the cards and closed the accounts, which is just surprisingly difficult to do. But I basically didn't use those cards ever again, got rid of them. And I've never been in that position again. Come close a couple of times, but yeah, it's really not a nice position to be in. So try and consolidate your debts so that you can eliminate them. The impact of compounding. So this is in the saving space, and it's a really interesting exercise to look at. So this can also work for debt as well, but I'm going to flip this around and look at it in the saving space. So if you look at, this is more the interest rate, but you can look at it in the saving space as well. But if you've got a mortgage of $500,000, and we've got two scenarios here. On the left scenario, it's $500,000 balance. You're paying the repayments fortnightly. Same interest rate. So I put a 6% interest rate there. The fees are the same. The fee frequency is the same. The only thing that's different is that you're paying your repayments fortnightly instead of monthly, which is on the right-hand side. You save 3 years on the loan and over $62,000, like literally paying the exact same amount, but paying it fortnightly because your loans are calculated on the daily balance. So your interest is being accrued every single day. So if you can pay that thing off faster, just look at it's just such a tiny little tweak. And of course, this isn't going to be something that gets largely broadcast by your bank because they want your extra almost $63,000. They don't want you to have it, and they want you to be in debt for longer. But can you imagine, like if your goal is to retire at the age of 65, but your current loan will take you until 68, this is the difference between being able to retire when you want and when your loan currently is ended. And the snowball effect it just feels so good when you see that balance start to plummet towards the end. I've experienced that and it's fantastic. So 3 years, just think about that. So have a look at whether or not you can pay your loan on a fortnightly basis, and that will take a bit of organizing of money, because if you get paid monthly, you're gonna have to. It might take a little bit of coordination, but it's worth it to do that. Now, the money pie is a system which is not a new revolutionary innovative system by any means. Some people call it buckets, and I know a lot of Barefoot Investor, he works this way, and there's similar. The way I do it though is a little bit different, and you can adapt it to suit you, but it's very much percentage based. And it works easier if you have a steady income. However, because of the percentages, you can apply it if you've got income that fluctuates. As business owners, I always have a business money pie, and then I have a personal money pie. And I try and automate the personal money pie as much as possible by paying the same amount out of the business into your personal account every month, so that you can systemize and automate your personal pie substantially. The business pie is set up a bit differently, because you need things like taxes, and you need to make sure you're paying yourself a salary and a profit. So it's still based on percentages. So from this particular instance, this is a personal money pie. You have the largest chunk, which is expenses and debt. If you can keep that to around the 70%, if you've got a mortgage or you're paying rent, then that's okay. I've seen some that are up to 85%, and that is way too much. It's almost unsustainable to be able to run a household on that much. So you have to, and once you've figured all this out, it makes it a lot easier to budget, which a word I don't enjoy, but you need to delve into the detail at least once to be able to come back and see it at this level. And then you can start to manage it more at this level once you know where you're at. So once you look at everything that you're spending, essentially, which is all the expenses and then any debt that you have to pay every month, then making sure to put some money aside for, I call it emergencies. I like the word buffer personally, because emergencies just seems a bit too, oh my gosh, emergency. But you can call it whatever you like, as long as it's essentially for put away, and this is for a rainy day, fire extinguisher, whatever you want to call it. I actually had a certain amount that I wanted to get to. Once I got to that amount, I've stopped adding to it. I've just let the interest, because these are all in high interest bank accounts. I've just let it tick away. And the money that I was putting in there, I've had to readjust my money pie, and now I put it more into invest. So you can adjust it depending on where you're at in your life. And you can also put, like, I'm saving for a car for 2 years. So I had a slice of my money pie that went into for a fund for the car. And these are separate bank accounts. You can use a bank that has your ability to split the fund or split the accounts into multiple accounts and have a high interest. At the moment, money actually does earn interest, which it hasn't done for a very long time. So make the most of it. And so fun is another one. Absolutely have to have a fun. That one is not negotiable, because if you're feeling like you're being too constrained, you will bust out and blow your budget substantially. So it's really, really important to have a fun fund. However much it tends to be. I've got clients recently and their fun fund is 20%. They love to travel, so it has to be higher. But you have to make adjustments elsewhere. You've got to find that money still somewhere, because ultimately this has to add up to 100%. And then kids' future, if you want, I save, I pool money between my mum and my husband and myself every quarter, and we put it into an investment fund. And I've got my spreadsheets to help me figure out where I had an end goal, and then I've worked backwards, so I see what return I'm going to get. And so I've got that built in to my system for creating wealth, is to be able to have something to give her, which will present its own problems when the time comes, because it's in a trust at the moment. And then investing, really, really important to do. And this is in addition to superannuation. So superannuation is a government's sort of set up structure. It does still belong to you, but the access to it and how you access it is at the government's discretion. So you want to still be able to have investment money that you control. Yes, you pay tax on it at your highest marginal tax rate, but it's still yours. So it's important to build this in. And this is where the wealth part really kicks in, is doing all of this in parallel, is making sure that you've got your investment. And if it's saving up for an investment property, or you can put it in shares, and I'll talk about some of the investment options in a moment, for actually building that wealth, but that is where your money will come from to fund the wealth creation. So that's really, really important. So building on the investing side now, when we look at what investing actually is, It's essentially a process to buy an asset that's going to increase in value and provide you with returns, or in the form of either capital gain, which is the actual underlying value of the asset increases, or you get income payments through like dividends or rental return or rental payments, all that kind of thing. So that's essentially what investing is. You're buying an asset that you know is going to make you money or increase in value. If it's not, then it's not an asset. It's not investing. Excuse me. So, ways to invest. There's a number of different things here. So, superannuation. I know a lot of people don't really think about that because it's something that just automatically happens. If you're running a business and you're paying into a super account, which I really hope you are, even though a lot of small business owners I work with don't or don't do it enough, that is an asset class in itself. You can buy property, commercial or residential. And you don't even have to buy the full property. I know when a lot of people think property, they're like, oh, I'm going to have to outlay, $1 million to buy a property. You don't actually have to. You can buy into a unit trust where you can buy an element of the property and you get an element of the return, but you also haven't had to invest quite so substantially. You can buy shares in a company. So it's exactly the same concept. If you think of a property and you think of a company and you're buying a share in each of those, you can do that now. It's so much easier than it ever used to be. You can buy bundles of assets. So there's things like managed funds, exchange traded funds, or ETFs have really like blown up over the last sort of 5 to 10 years. And it's so much easier to invest in them now. And you get access to a wide range of assets and companies that we never used to have access to. So it is so much easier now to build wealth with less than it ever was. Foreign exchange, yes, you can actually buy foreign currency and make money on it. So foreign exchange trading, that's a thing in itself. So I would highly recommend you become educated before you even try and go down that path. You can pay somebody else to do it for you, but it's still worthwhile you knowing at least the basics of it. Then there's digital assets. So we've all heard about Bitcoin and cryptocurrencies and all of this. They're a whole different, they're not actually even considered a proper asset class, but people can make money on them. People can also lose a lot of money on them. And then NFTs are non-fungible tokens. I personally don't totally understand these because they're completely intangible, but people can trade them and you can make money. Again, you need to become informed before you and educated before you endeavor to invest in those sorts of asset classes. And then there's other types as well. You can invest in gold. I know my grandmother back in the day liked gold coins. So you can invest in gold, silver, commodities, so like nickel and coal and iron ore, and art, isn't sculpture, gems, jewelry, there's antiques, there's so many different other options there as well. Again, they take a certain amount of knowledge to invest in those too, and most of them are about capital growth. They're not going to give you an income, whereas property and shares and the bundles of assets will give you an income, hopefully, if it's the right asset. So they're the different ways to invest. And then what do you do with that? Understanding your risk profile is really, really important. And before I said I was low risk, that's my personality. I don't like to be in debt. I like freedom to be able to do what I want, and I don't want a bank to control or own anything of mine. That's just the way I operate. But you've got to, sometimes you've got to, spend it to make it, so to speak. But you've got to do that within your risk profile and your comfort zone and where you want to go. Like, do you want to make a squillion dollars, or is your goal to have like $10 million in property by the time you're 50? You can, but then you're going to have to take on debt to do that, unless you've got an amazing paying job or a business that's going to generate that amount of money for you. So it really depends on your circumstances. It also depends on your age. Our risk profiles tend to change. We tend to be a bit, more risk tolerant when we're younger, and then we become a bit more risk averse as we get older because we've got a certain amount of working life left, and we want to be able to have money to enjoy our life. So our risk profile tends to change a bit, and our ability to handle the ups and downs in value. I remember talking to a lady at an expo once, and she was just like, "Oh my gosh, I'm so stressed. I keep looking at my retirement fund balance, and it's not healthy. It's just not." I said, "Stop looking at it. just stop looking at it, at least so regularly. You know, she was looking at it every week. And I was like, oh my gosh, just it's going to stress you out no end, which is not going to do anything for your blood pressure. And you still want to be around to enjoy that money. So just don't look at it. So that's another part too, is if you cannot handle the kind of swings and changes that go with investing, and I'll explain the difference between investing and trading in a moment, then just look at a different kind of asset class. The length of time that you have to invest is also important too, because a lot of the more risky investments, if you're in them for a longer period of time, then the swings can tend to even out a little bit more. Like even with like the big dips, like in the GFC and a lot of those others, most of those assets have actually pulled back over time. I've got a chart which I'm going to show you shortly. So if you just stay in it, what happens when people panic, when things plummet, they're like, oh my gosh, and they sell. It's like, why sell if you don't if you don't need the money? Basically it's not worth a whole lot as it was, you know, maybe a week earlier. Just stay there, just ride it out. So if you, the more time you have, the more able you are to handle those ups and downs, which is where the age part comes into it as well. Complexity. How complex? I remember I was looking at doing a property development with my mum, and the way it was going to be structured was because I had another party that was coming in, and it was so complex. In the end, we ended up just having to pull the plug. So like, this is just too complex, too many moving parts, too many things that could go wrong, too many's. And that's where I learned a lot about myself in that process as well. Liquidity, that basically means how quickly you can turn your asset into cash. So for instance, cash in the bank is about as liquid as you can get. Even a term deposit is slightly less liquid because you've got to wait for it to mature. Shares are not too pretty liquid because you can sell them, you know, and a few days later have the money. Property used to be, and it's sort of heading that way a little bit more, is probably one of the less liquid because you've got to, you know, spruce up the property first. You've got to put it on the market. People have to come and look at it. You have to have there's time. And then there's settlement periods. So you're looking generally minimum 3 months. So if you need money really quickly, which is why you have an emergency fund, which you can get access to immediately, property is not the right place to put those kind of funds if you need the money quickly. So again, compounding returns. So this is the flip side. So helping you pay off your home loan faster by making those repayments more regularly. Saving. And this is why when people are like, oh, I don't have the money, or I should have started 10 years ago. I'm like, yes, you should, but then there'll be another 10 years. So start now. Don't wait anymore. So if you start, this is an example here. If you started with just $100 and you invested $100 every month, and we're going to assume a 5% annual return, which is, you know, this is investing. This is it's still pretty conservative. And you did that over 20 years, you would end up with just over $41,000. If you then upped that to try and keep in line with inflation, so that $100 didn't change over the 20 years. Inflation, time value of money, has sort of decreased, but you haven't changed it, but you've still got $41,000. If you start to invest $100 a month, but then increase that contribution by 5% every year, and you get 5% return on top of that, over the 20 years, you'll have nearly $63,000. So that's an extra 20 grand. So it's important to get started and to do it consistently. Money is all about creating a system and then just rinse and repeat. Just keep doing it. Just keep doing it. Keep doing it. Make it manageable. Get into the habit. Automate it as much as you can. Just do the thing on a regular basis, which is why, like, I have a reminder in my phone, a recurring reminder for every quarter. Collect the you know, a set amount of money from my mum and my husband, and then I invest it for my daughter. And I've been doing that now for nearly 10 years. She just turned 9, and I started just after she was born because I needed her to be alive before I could start the investment with her. So 9 years I've been doing this regularly, and it's grown quite well. So, and then I'll get to micro investing in a second, but that's just regular. It's just consistency. And oh, I just remembered I didn't talk about the difference between trading and investing. When I talk about investing, I literally mean buy and hold. Trading, which is when we're talking about foreign exchange trading, is a very different beast. When we hear the word investing, quite often in our minds, we go to trading, which is buying and selling. Buying and selling. It's the stuff we see in movies, you know, on the floor in Wall Street, and they're buying this and selling this, and it's all very dramatic. That is not investing. That is trading. Investing is literally buying an asset, holding the asset. You could eventually sell the asset, preferably at a profit, but it's not buy, sell, short term, you know, do this, did it. It's buy and hold. Okay. So this is the chart that I was telling you about. So there's a whole lot of data in there, but ultimately you can see some dips, and there things like, there was a 1987 stock market crash, the GFC in 2007-8. Then we had COVID in March 2020, but it's always recovered. It's always gone back up again, and ultimately that's the message. And it would have been great if you get in here and it's now here. You'd be like, oh wow, I bought Apple when it first came out. My husband and I were just joking yesterday if we'd bought Facebook shares when they first came out, and they listed initially, they tanked. I was like, well, should have bought then, and then now they've gone back up again. 2020 hindsight's a beautiful thing, but ultimately it will keep going. There will be dips, but it's about being in the market and then the time that you have. And there's always this thing, it's time in the market, not timing the market. And it's a little bit of both. There is a little bit of both. Quite often I've noticed October is often when things tend to crash, like whenever there's major dips. COVID was an anomaly, that was in March, but quite often it seems to be around that time. But anyway, but you see, it just keeps going back up again. So it's really important to actually invest. That's really the only way that you're going to create wealth. And if the concept of investing is too scary, start with micro investing. This has, I shouldn't say revolutionized, but it's really opened up the access that people have to growing wealth and investing. It's tremendous. I started, again, I'm low risk profile, so micro investing suits my risk profile. I started by investing with a company called Raise. They were Acorns when they first came to Australia. And I just did roundups. And that's all I did for the first 5 years. I was like, every time I pay for something, it's going to automatically round it up. Once it gets to a certain amount, it will invest it in like a pooled investment type of thing. I won't go into too much of the technical detail. And I had $5,000 after 5 years. And then I thought, well, what happens if I chuck an extra $10 in there? And it had gone up to $6,000 within 6 months. I was like, oh, this is fantastic. So now I just let it tick along. I've created a sub account for my daughter as well. So she's got yet another account. And I've opened up another one with another provider that does more fixed interest. And so I've got it, and that's just ticking along. I add to it, it does its thing, and it's small bits, but it will add up. Like I said, I've got thousands in there now, which I wouldn't have had. It's not like I've got a piggy bank that I'm just putting that money in every day. It's allowing me to do it, and it's automated it. I just sits there. I check the app and I'm like, oh, cool, that's nice. But it's money I would not have had. So micro investing, and you can micro invest in many different ways. You can even micro invest with crypto. You can micro invest with gold. There's lots of different platforms now that have really opened this up. I do have a free download on my website if you want to have a look, and it's how to get started with micro investing. If you want to know a little bit more about it, and I go through some of the providers and the differences between them as well. But it's really, really important to start investing. So back to my wealth in motion. This is the main message I really want you to get out of today is you've got to do it all. Even if it's just a little bit, do a little bit of everything. Do a little bit of saving. Make sure you know what your money pie looks like and that you're allocating money for investing. You're still paying off your debt. You're still working. You're doing the things, but you're doing it more consciously and more deliberately. And then when you can see your money, you can better go, oh, wow, I didn't like, I literally had a client recently, and they are a family of three. They spend $20,000 a year on groceries and another $12,000 a year just on eating out. And they were like, whoa, I didn't realize we spent like $32,000 a year just on food and coffees. And they're like, wow, okay. So now they know that they can start to go, okay, well, maybe we can pull that back a little bit, but we also know we need to save for our daughter's education. So we need to cut back on some of these other areas, maybe, catch the train to work a bit more and pay for parking a bit less, or maybe eat out a little bit less. Maybe get a coffee machine at home and make some really great coffee and, buy one of those nice keep cups and take it with me rather than constantly spending all this money on coffee. Or if that's important, find it somewhere else. So it really allows you to make those conscious decisions. But while you're doing that, make sure you're putting money aside because you can see what's left. Otherwise, it just disappears. If you've got money left over at the end of a month, where does it go? It just goes. Unless you have it earmarked and pegged for something, create a micro investing account that automatically deducts. Set up a trading account and buy some shares, get some ETFs, buy some index funds, something like that helps you little by little. Just gain enough knowledge to allow you to take action. Look at how you can pay off your debt, especially credit card and personal debt. Get rid of that. If your home loan, depending on your home loan rate and what you can make in the market, sometimes it actually makes more sense to just pay your home loan off bit by bit, but invest the rest. Because if you can get an 11% return on an investment, but your home loan rate is 6%, you're going to make more investing in the share market than you are by paying off your home loan. So it's important to do these things in parallel, which just blows our minds because we're not taught this. It's not presented to us in this way that we can do these things and make these decisions. And we don't have to be mathematical geniuses either. So that is the message that I want you to get from today is think of the wheel. Think of the wheel. So what we covered is, what does wealth actually mean? What is it really? And what are the elements of wealth and why are they important? And then what for you to do next? Get your vision on your money. It's really, really important. You will regret it if you don't do it because in 5 years' time, and time will fly, like I said, it's already June. You'd be like, geez, I really wish I did the thing that the chick said in that webinar thingy, like however many years ago. Start it now. And if you're really not sure, then I do have a couple of things that can help you with it if you want. Otherwise, you can start to figure this out your own. I know you can. But if you want a one-off like strategy session that takes an overarching look at your finances, how it's structured, what's blocking you at the moment, that's what this is about. It's a one-on-one session with me, either in person if you're in Brisbane or online. We go through what your priorities are, we help you clarify, help talk about what's blocking you and what's been hitting you in the past so that it can help you move beyond that. So that's the money management assessment. So that's to take a holistic view of your money, and there's a booking link in there as well. The other thing that I'm offering as well is I'm just launching this Money Essentials for Business Owners program, which is currently waitlist. It's going to be launching in July, just in time for the new financial year. And this will help you understand how to systemize your money. So this is me showing you how to do it. And you can go back, there's a workbook, there's live sessions where you can ask questions. They're also recorded, there's checklists, there's calculators. The tools, all the tools that I use with myself and my clients are included in this. So it shows you how to systemize your money. It helps you build your money pie. It helps you see and visualize your money, and it helps you understand what your end of month sort of checklists will be for both your business and your personal finances and how to integrate them better. So there's an upfront fee or price, and there's also a full monthly payment. So I wanted to keep this really reasonable to make it accessible. So if you want, there'll also be a waitlist bonus as well, which includes a one-on-one session with me. So if you join through the waitlist before the middle of July, you will get that in addition. So any questions? And I might just stop the recording there because sometimes people feel a little uncomfortable asking their questions live. So I will stop the recording. I think I have to stop sharing first before I can stop the recording.